Good day, ladies and gentlemen, and welcome to our class on the reversal trade. To stop predicting and start reversal following. In other words, we'll no longer just be looking at charts and trying to pick out trades. We're actually going to be finding them and following them to make the right decisions. Now, trading doesn't always go smoothly, especially for the retail crowd like us, as it does for the professionals. To name but a few, the size of capital and the access to information are some of the disadvantages that retail traders have to cope with. And actually, the size of our account, our capital, and leverage is the biggest difference between a guy who's trading for a private bank or a guy who's trading a $100 million account, or us that's trading a couple $1,000s in leverage, because we can't afford to let the markets even take a breather against us for a second. Unfortunately, most retail traders do not succeed in Forex or CFD or crypto trading, with estimates putting the number of successful retail traders in the range of 2 to 5%. This means that the other 95 to 98% of traders ultimately lose in the wilderness of the exchange rate fluctuations. Now, unfortunately, too many people, traders, housewives, husbands, part-timers, enter this market and think that they can either get rich or make money, but they don't realize it's a lot of work. If a professional football player has to spend all day, every day, watching videos or film of his opposing team, studying plays, making decisions, memorizing everything, and then going out and doing scrimmages and practicing on the field. Now, granted, they get paid millions and millions and millions of dollars. But so does the guy who's playing semi-pro getting a little bit of money. Why don't you have to be any different? Or why do you think you should be any different when you want to enter this arena? And there are certain ways that we can be successful, because it's not always easy. So if you've been trading for more than a week, you probably asked yourself these questions multiple times. How do I accurately determine when to enter a trade? What things like trade management, exit strategies, and disciplines are also big contributing factors towards your performance. Picking a good entry point will increase your chances of having a winning trade on your hands. Because remember, until you've actually made a trade, you're not in the arena. You're on the sideline. But once you push that button and execute a trade, you're in the game. And if you're going to try to win that game, you need to understand all the rules. You understand all the plays. You need to know all the players and your opponents. And once you do that, you'll find that you can actually master the market. Now, to learn any strategy, and today we're going to be learning the reversal trade strategy, you have to understand some market basics. A lot of people will just ignore all this. A lot of newbie traders and even some semi-experienced traders have no idea how to answer these questions. But understanding the stages that a market goes through is crucial when trading the financial markets. The cycle is unique, and each stage has its own driving factors. And the 4 phases of a cycle are accumulation, markup, distribution, and markdown. And you need to first look at the asset you're considering, the security you're considering, and determine where it is in its current unique phase. So we start out, any asset starts out going through the accumulation phase. With the first stage, there's a process of accumulation. The accumulation stage is usually driven by large institutional demand. The results of this phase is the buyer slowly gaining traction in the markets. In other words, you're looking at an asset that's been trading sideways, and it starts to move up a little, but not with any great conviction. But usually that little move up is brought to us by institutional traders and big guys. We're just starting to see it. The asset's just starting to accumulate. So we go through this little bit of a phase, and it starts to accumulate here, and it's coming out of its sideways action. And from there, we go into the markup phase. This is the point we need to be very concerned with. The second phase within this trading cycle is the markup. This is where the buyers take over and gain traction. Now remember, it's the exact mirror image opposite for a downtrending market. Prices push through the upper resistance levels of the ranging market. Candles start to close with strong bullish bodies, sending a signal that the price is entering the second stage. In this stage, there's an emerging bullish trend in price. So what do we call this? The markup phase. So we start with the accumulation phase, and then we go to the markup phase. Then we go to the distribution phase. And these are important to remember because we're going to be looking at these because you will be applying these actually when we do our reversal trade setup in a few minutes. So in the distribution phase, is where the sellers are attempting to take back their positions in markets. Similarly to the accumulation phase, price action on the chart is kind of flat. This is signal that the failed break at the upper level of the market structures. Price consolidates, creates lower highs, indicating there will be a sell-off taking effect. And we go to this distribution phase. So what we did is we had this sideways action, and then the buyers started to accumulate some positions, and they started to move it in the accumulation phase. Once we top that out, we're not sure it's going to reverse yet. We're not sure if it's taking a breather, and we go into the distribution phase. Now, it could go back into accumulation stage, but standardized with the 4 cycles, we're going to go into a markdown phase because prices can only be doing 3 things. They can be going up, sideways, or down. Most of the time, when price moves up, it moves down almost the exact same amount on the opposite end. And from here, after we go through the third phase, we go into phase 4, the markdown phase. This is the last and final stage of a market cycle and is labeled a markdown phase. This process occurs after the distribution of the higher prices. The sell-off drags price and the market begins to downtrend. This process provides an indication that the bears have taken over the market and have gained enough strength to take price within the market to a cheaper level. There is a confirmation of this when price action shows a break of the lower level of the flat ranging market. Technicals show large candles sticking out of the descending horizontal distribution channel on the chart. And this is where we go into the markdown phase. Okay, and it can start in a unqualified trend, or it'll eventually move into a downtrend that's got lower lows, lower highs, lower lows, lower highs, and we can see the development of the opposite move of the markup phase. So there are different setups depending on the price action, understanding what market phase we are in, because each setup doesn't work correctly for each wave or phase of the markets. So you have to understand where we sit in the market. So the first thing we need to do is when we're looking at an asset for a potential trade, we haven't made any decision yet. We need to identify where it sits in what phase. Now today we're only going to be looking at a reversal trade setup because it would take hours and hours and hours to go through. There's a zillion types of trade setups and a zillion types of market trade setups we can use in different markets. Trading reversals is a popular trading style. Traders tend to wish for picking the exact bottom or the top and catching a strong reversal. We wish, we hope. Too many newbies think that they can do it, and we call this catching the knife because you'll never catch it at the very bottom or the very top. Another challenge is that trading reversals requires more precision than trading with trend setups. When people hear that you trade reversals, they immediately believe that you are trying to predict the change in direction or follow the catching of a falling knife trading approach. It's important to understand that reversal trading is not a trading style that predicts whether markets are going to turn or try to trade the absolute high or low. But the reversal trading can and should be something very different. The best reversal traders don't predict. Period. End. They sit back and they wait for clear signs that the market has already turned. Reversal trading then moves away from price predicting and to price following, and how I like to call it, reversal following. Trading and building an edge is all about stacking the odds in your favor. However, it's important to focus on what's really important and to avoid what we call paralysis by analysis, which exists when you add too many tools, indicators, rules, and price filters to your method, that making a trading decision becomes too complex. To be honest with you, making a trading decision should be pretty simple. It's all the stuff that goes around it. It's your risk management, your stop loss payment, your target payment, your exit strategy, your strategy what to do if the market doesn't do what you predict. Okay, entering the trade is, I'm going to enter, I'm not going to enter. You enter a trade and it's figuring out the price you want to enter. But it shouldn't be overly complex, because it's just a step into the arena. Okay, what you're going to do once you're in that arena, you don't really know. Imagine, we're going to go back to ancient Rome and you're sitting there, you're a gladiator. Okay, you've got your sword and your spear, your armor, and the gate opens up to let you in that arena. You don't even know what you're facing. All of a sudden, what comes at you is 6 people with great big, huge muscular guys charging at you. You're going to respond to that. Now, you know what your ultimate goal is. You know what you're going to do when, you've already worked out in your mind how you're going to accomplish your goal, but you don't know what's going to happen until those gates open. And to be honest with you, you can either end up bloodied, you can end up the winner, you can end up dead. Okay. So when it comes to your trading methodology, ask yourself what you want to achieve and what the premise of your system is, and then pick the tools accordingly. Now, for reversal trades, there are 3 pillars in our Colosseum that we should be looking for. Okay. Trading and building an edge is all about stacking the odds in your favor. Okay. When it comes to trading methodology, ask yourself what you want to achieve and what the premise is for the system. If you're a reversal trader, you want to look for fading momentum, support and resistance areas that can't be broken, and price confirmation of shifting powers between bulls and bears. The most important reversal price pattern are the 3 inside up, the pin bars, the 3 black holes, and the engulfing patterns if you're looking at candles. It's not so much about the patterns themselves, but what the path of price tells you about the underlying dynamics. So when you look at this chart, okay, it's not necessarily what the candles are telling us, it's what we're seeing the path. Okay, where we determine what phase we're in, we actually see a 3 inside up pattern, which tells us we have a beginnings of an uptrend. We see here a failed break of support, broke it twice. Okay, and below we actually have divergence with our RSI. Our RSI moving out of oversold territories, moving back into middle territory, while at the same time price is easing down, our indicator is moving up. So fading momentum is important, whereas many reversal traders just try to trade off previous support and resistance levels. Waiting for confirmed fading momentum can make a huge difference. The RSI or stochastics indicator are good choices when it comes to analyzing momentum. So when we get momentum divergence, we actually get fading momentum. And the last main pillar of the reversal is to find reversals that happen at logic price areas. Most traders make the mistake that they just look for a divergence on their indicator and they hope the trade will somehow work out. Well, price trades somewhere in the middle of nowhere. Taking reversal trades that happen at the right price are key. For that, you should consider looking for false breaks of support and resistance levels, or previous highs and lows. Fibonacci's are another great tool. Here we'll take a look at here on my chart. We can see how price moved up here to the top, and we got a rounded action off of the 1.618 extension of the fibs, and we saw price move into a reversal. So here we have the run up, the accumulation phase, the markup phase. We went into the sideways, and then we went into the markdown phase. But what do we have? We have a beautiful divergence. If you're a divergence trader, we have a denial of resistance. Okay, so we have all the pieces to give us a price area of interest. So if all these things come together, you often get a very precise signal for an imminent market reversal. Furthermore, by the time you see all the three things on your chart, price will have already turned into the opposite direction, and reversal predicting actually becomes reversal anticipating. Most traders who claim to be reversal traders are just trying to call tops and bottoms and predict market turns well in advance. Successful reversal traders enter way after the top or the bottom has formed. To trade reversals profitably, you have to be okay with watching your trade setup unfold while you're standing on the sidelines and waiting for the perfect moment to jump in. So let's break it down to steps. Step 1, determine if the market conditions are favorable for a reversal trade strategy. Well, think about this. This is a trend reversal trading strategy, right? This means we must wait until the end of the trend before entering a trend reversal. We won't be able to get into a high probability reversal movement until then. Okay, don't over anticipate. Don't want to jump in the markets. Don't try to predict. Wait for the reversal. Now, what happens if we execute trades whenever the rules of engagement of the strategy are met without considering the market conditions or locations? Never. We will end up executing trades in trends and consolidations, right? This is a quick way to blow our trading account. That is why trade location is important. What would be the ideal market conditions or location for a reversal trading? To understand that, first you must understand the 4 market cycles we talked about. So let's take a look at the chart again. Okay, here we've got it separated. We have the accumulation stage, the markup stage, the distribution stage, and the downtrend stage. It's not hard to draw them on your charts when you see them. If you can't find them, then go back to another time frame. Okay, or just don't use that strategy for that trade. So according to the chart, you can see the market cycles go through those 4 main stages. It's not something I'm making up. It's universal. So remember, we discussed all this earlier at the beginning of the class. Accumulation stage, markup stage, distribution stage, and markdown stage. Now, if we've isolated these, and then you combine it with an indicator, a simple indicator like RSI, we might have something that's telling us something and confirming something for us in the market. So according to the chart, you can see that every time RSI is oversold or overbought, the market is either going up or down. So let's take a look at that chart again. Okay. RSI below, pushing all the way up above the center line and moving up towards the overbought area in green. In the tan, we're going into the oversold territories. In the pink, we're going into the overbought. And we can see the rhythm between what's happening in the market and where RSI is. Okay. So according to the chart, you can see every time RSI is oversold or overbought, the market is either going up or down. This is easy and objective way to pinpoint accumulations and distributions in the market. Now that you know the first step, let's see if we can identify more market bottoms and tops. Okay, so the first step is done. You now know how to identify the correct market conditions locations, which are a high probability for a market reversal. Just a high probability for a market reversal. That's all you've done. All of this time we've gotten through step one. So with that, let's go to step two to see if the market location we've highlighted for a potential for a market reversal. So step two is identifying the weakness in the current trend. So previously, we have identified the higher probability areas for possible market reversals. Now it's time to identify if there's a possibility for a market reversal in the same area. So in this step, we are going to identify the weakness in the current trend so that we can prevent from getting caught in a retracement. Because we're not looking for retracement, we are looking for reversals. So how are we going to do that? Well, this is where the 2-hour time frame and the RSI divergence comes into play. We started out in the beginning really looking at 4-hour charts. For our type of trading, a 4-hour chart, then we go to 2-hour, and then we go to 1 hour, and we might use a 15-minute or 5-minute just to make our entry level, our entry point. So, but keep in mind, this is a step-by-step process. Therefore, first we need to identify the 4-hour overbought and oversold. Then at the same area, we need to identify if there's any RSI divergence, and we do that in a 2-hour chart. To understand this clearly, let's take a look at the chart. Okay, so here above we have the 4-hour chart. Okay, we've identified the areas, and we see that we are in a we're in a distribution center, distribution wave. Okay, we have RSI being overbought, so that would tell us something from step one. Now we drop down to the 2-hour chart, and what do we end up seeing? We end up seeing that same area, because we want to keep that same area we've highlighted, in a divergence with RSI. So now, according to the image, we have a 4-hour chart above and a 2-hour chart below. Okay, we looked at the 4-hour chart and we saw the RSI overbought and oversold, and then we dropped down to the 2-hour chart and identified divergence. So far, we have identified what? In one, the higher probability area of a possible market reversal. And then in two, we confirm the likelihood of a market reversal by identifying RSI divergence. Step three, we use momentum shifts to confirm the trend reversal. First, we have to understand what a momentum shift is. Momentum shift is when the price shows strong opposite momentum against the current trend. When this happens, we call it a momentum shift. So assume that we are in a strong uptrend, and all of a sudden price rapidly starts to move against the trend, indicating strong bearish volatility. When a scenario like this occurs, we can say that, okay, this uptrend is slowly losing momentum. Therefore, we can expect a bearish reversal. Is that true? Well, to be exact, during an uptrend when price breaks below the 50 SMA, we can call it a bearish momentum shift. And on the other hand, when price breaks above the 50 SMA, during a downtrend, we can call it a shift in momentum. Now, there's many indicators we can use, whether using MACD. There's many momentum indicators. You can make it complicated, but a simple moving average on your chart, when you see price moving above it and breaks above through it, we have a momentum shift. When it goes through downward, we have a momentum shift. So that's it. But there's one condition. You know, it's never that easy. That is, price action should respect the 50 SMA. To find that, you may need to shift between the 2-hour and 1-hour time frames. For example, if the price action respects the 50 SMA on a 2-hour time frame, then you need to switch down to a 1-hour time frame and make sure that it is still respecting it. If not, you must switch down to a 1-hour time frame. Note that the lowest time frame we are switching to is 1 hour. Don't go below that for setting up your trade. So 4 hour, 2 hour, 1 hour. Okay, so we use the 4 hour to isolate the zone, figure out where we are. We look for overbought or oversold. We go down to the 2 hour and we identify divergence. We go to 1 hour and we get the break of the SMA. And now we have a momentum shift. So we have step 1 completed, step 2 completed, and we have the momentum shift in step 3. Don't worry, we're not done yet. Nothing's ever that easy. So on the first chart, which is a 4 hour, we have identified a trade location using RSI. Then we've identified the RSI divergence and confirmed weakness of the ongoing trend. So in this step, we have to find a momentum shift to confirm a market reversal. We have to look at the 2 hour chart and a 1 hour time frame. And we have to look at the 50 period SMA. Now, like I said, you can convert this. You can use a 20 period, but once everything you're changing changes it from what I'm teaching you, which doesn't say this is the only right way, to becoming your personalized way, which is an important way about trading. But you also have to test it. So once we see price climb above or fall below the 50 SMA, we have that momentum shift. So let's break the chart down using the steps we've learned so far. Okay, let's go. Let me get back to the chart. I just clicked too fast to it. Okay, so we have 4 hour. Isolate the area with overbought. Drop it down to 2 hour and look for the divergence. Drop it down to 1 hour and look for the momentum shift. Now we have to go on to step 4. How to capture the market reversal at the right time. In this step, we are talking about trade entries, stop losses, and take profits. Your most important part of everything. When talking about trade entries, we need an entry method with a high probability and a maximum profit potential. Okay. So remember, the trade entry is the opening doors to allow you into that arena. Well, we are going to use the most profitable reversal trading patterns to increase the odds in our favor and to cut the losses upon the trade entry when the market is not reversing the way we want. We will use our cutting loss method. So that you have a massive profit potential with a small bunch of losses. Now, what are the reversal patterns we're going to use? Double tops and double bottoms. I don't particularly like double tops and double bottoms. I prefer triple tops and triple bottoms. Head and shoulders pattern. Well, we hear about it all the time, except it takes way too long to develop. Break of local structures. Support and resistance is a great way to do this. Momentum drive patterns. So I hope you're familiar with these patterns, because in the class today, we just don't have time to learn chart patterns, but we have whole classes in chart patterns. So now let's take a look at the same chart example and see what the reversal we have and how to place our stop losses or take profits. So here we're back to our same 4 hour chart. We're looking at our 2 hour chart. We've isolated down to our 1 hour chart. Our 1 hour chart is where we start looking at the trade mechanism, the actual trade, where we're going to put our stop loss, where we're going to put our take profit, where our target points are going to be. Okay. All the way leading up to step 4 was just deciding whether we wanted to take a trade and whether the conditions were right. So step 1, we had the 4 hour time frame for overbought and oversold. We had the 2 hour, step 2, we went to the divergence for the 2 hour. Step 3, we look for the momentum shift using a 50 period SMA. So then simple, after identifying the reversal chart pattern, in this case, it's a momentum drive pattern. We just have to place a sell stop a few pips below the market zone and observe the 1-hour chart, and you can see we have placed an entry a few pips below the market zone. So let's go back to that chart once more. Okay. So we've got our confirmation. We're going to sell into this market. We're going to put our entry point a few points below, our stop loss above our highest point in this phase, and our target point we would have set by looking at our Fibonacci's, our support and resistance, and setting it below. Now we can't make up a market target point because we need to have a valid target point to build and verify our risk-reward process to make sure that there's enough potential profit in this trade to offset our potential risk. So where would we be doing that? Well, on a fib, maybe we'd be doing it 50 or 100%. So for the take profit, you're going to go to 4 times, which means 4 times your stop loss. For example, if your stop loss is 20 pips, then you need your target profit point target at 80 pips. Then you want to study the chart carefully to see if you can possibly place it. If there's not a major level of resistance, there's not a major indicator, and it's a strategic price or around the strategic price, then you're all right. After we completed all 4 steps we've discussed thus far, we can move on to grading our trade setup. We still haven't made a trade yet. Now this step is all about grading our trade setup, and for that we just need to find out if there's another trading confluence aligned with our reversal trade setup. We need to verify this. If there are more confluences, then we can mark that particular trade setup as a high probability trade setup. If not, it's just a normal trade setup, and we only want to make high probability trade setups. So the difference between these 2 grade setups is that we have a high probability trade setup, period, the end. If we don't, then we don't want to trade it. We only want to take trades with high probabilities. Only trade the higher probability setups. There's always going to be another setup. And with that, it's the end of my talking today. Thank you very much for joining us. Have a great trading week, and that's all, folks.